PLT Limited is a resident company that trades profitably. In order to distribute franked dividends to its shareholders, PLT needs to maintain a franking account and ensure it has sufficient franking credits. As part of the imputation regime, resident companies will maintain a franking account, which is a standalone account that does not form part of the company's financial statements. The franking account is subject to debits and credits arising from certain transactions. Credits to the franking account increase its balance and arise from a variety of transactions. Most commonly, credits arise from payments of PAYG instalments and payments of company income tax, as well as the receipt of franked dividends from other companies. Debits to the franking account decrease its balance and arise from a range of circumstances. Most commonly, debits arise from the distribution of dividends with franking credits attached. PLT Limited had a number of transactions during the tax year, including payments of PAYG instalments, receipts of franked dividends, and distribution of franked dividends. Ideally, at the end of the tax year, a company's franking account should have a positive balance, that is, be in credit. If it has a negative balance, it generally means that the company has paid out an excess amount of franking credits, and then the company will be liable for franking deficit tax, or FDT. In this case, PLT Limited has a negative balance at year end, and FDT will apply. FDT immediately credits the company's franking account to return it to a nil balance as at the start of the next tax year. The actual FDT amount is payable by the company on the last day of the month following the end of the company's tax year. The payment of FDT is effectively a payment of company income tax. In this respect, it is generally not a penalty because it decreases the company's current or future income tax liability. However, in instances where there is an excessive end of tax year debit balance, the company will be liable for a penalty. This will be the case where there is a franking deficit at the end of the tax year and the deficit exceeds 10% of all the franking credits made to the franking account for the year. For PLT Limited, the negative balance is not considered excessive. However, this wouldn't be the case if PLT Limited had a franking account deficit at the end of the year greater than 10% of the franking account credits. When the franking account deficit at the end of the year is considered excessive, only 70% of the FDT paid will offset the company's tax liability. This is, in substance, a penalty for the company in that not all of the FDT will reduce the company's income tax liability. For instance, if a company with an excessive franking deficit of $10,000 pays $10,000 in FDT, only $7,000 will reduce the company's income tax liability, whereas the other $3,000 will effectively be a penalty. In some instances, however, companies considered to have an excessive franking balance deficit can seek relief from this 30% penalty. To recap, a franking account is required for resident companies and is subject to a series of debits and credits. If it has a negative balance at the end of the year, franking deficit tax is payable, which brings the franking account back to zero and reduces the company's income tax liability. Where the negative balance is excessive, only 70% of the FDT payable can be used to reduce the company's income tax liability.